Everyone thinks debt is just a number, a technicality on a spreadsheet managed by men in suits and central banks. But what if debt itself behaves like a living organism, one that grows, ages, and eventually turns on its creator every 80 years? Look at the calendar. It's 2025. The headlines talk about elections, inflation, interest rates, all the surface causes. But the real clock isn't political, it's financial, and it's ticking toward a strange pattern economists rarely mention. Every 80 years, the world's major economies hit a wall of compounding debt they can no longer roll over. The last time it happened was 1946, as nations crawled out of the wreckage of World War II. Before that, the 1860s, when empires drowned in war bonds and industrial speculation. And before that, the 1780s, when the French monarchy printed its way into revolution. Each time, the story looked different on the surface, but the mathematics underneath was identical. Everyone blames war, corruption, or ideology. Yet behind every crisis, the same quiet process unfolds. Governments promise more than they can pay, bankers lend knowing repayment is impossible, and the system survives only by issuing new debt to pay off the old. It's the oldest trick in civilization, and the one that always ends the same way. The paradox is that it works perfectly, until it doesn't. In the early stages, debt feels like growth. Bridges are built, wages rise, and stocks soar. Politicians look like geniuses. Then comes the moment when the interest, not the debt itself, but the interest, begins to outgrow the economy. It's invisible at first, like frost under the soil. But once the numbers cross a threshold, every decision that follows is an act of damage control. History calls it crisis. Arithmetic calls it inevitability. The world today carries over $315 trillion in global debt, triple the level of 2000. Interest payments alone are larger than the GDP of most nations. The United States, the empire of our time, now spends more servicing debt than on defense. The same ratio killed the British pound in 1949. The same ratio bankrupted Spain's silver empire 3 centuries earlier. When the cost of yesterday eats the income of tomorrow, time itself becomes collateral. We like to think modern finance is smarter, that algorithms, derivatives, and central banks can outwit gravity. But the pattern keeps returning, every 4 generations, almost to the year. Debt grows, confidence peaks, credit freezes, and society rebalances through default, inflation, or war. The next rebalancing year, according to the cycle that began after 1946, points to 2026. Not because of astrology or prophecy, but because compounding mathematics simply runs out of runway. If you listen carefully, you can already hear the language of the endgame. Unsustainable, structural deficits, higher for longer. These are the polite words that always precede systemic reset. The same words were used in 1930, in 1873, in 1788. Empires don't admit default, they disguise it under reform. So the question isn't whether the 80-year spiral will complete, it's how this generation will disguise its reckoning. Will it be inflation, digital currency reform, or another temporary emergency measure that becomes permanent? If you're hearing this in 2025, understand, what's coming isn't new. It's the return of a pattern older than capitalism itself. We've been here before, but this time the numbers are larger, the illusion stronger, and the margin for error smaller. To understand why 2026 matters, we have to rewind to the last time the world tried to escape from debt gravity. 1944, Bretton Woods, New Hampshire. The war wasn't over yet, but the financial engineers were already rebuilding the world's scoreboard. Gold would anchor the US dollar, the dollar would anchor the world, and every other currency would orbit around it. It looked like order, but it was really a managed illusion, a pyramid with one golden brick at the top. The key players were few. John Maynard Keynes representing Britain, Harry Dexter White for the United States, and behind them, the invisible hands of the new empire, Wall Street and the Federal Reserve. The mechanism they designed was simple on paper. Dollars convertible to gold at $35 an ounce, credit coordinated through new institutions, the IMF and the World Bank. Officially, they called it a stability system. In practice, it was a way to transfer the world's post-war savings into the U.S. financial system. Why did it work? Because the world was exhausted. Europe was bombed out, Asia was broke, and America alone held 2/3 of the world's gold. Everyone needed dollars, so everyone agreed to pretend that dollars were as good as gold. That act of collective faith birthed the modern debt cycle. At first, it was elegant. Nations could borrow to rebuild, the U.S. could lend by printing, and trade could flow without settling in gold each time. Debt became global oxygen, invisible, necessary, and constantly expanding. The genius of the system was psychological. It replaced metallic scarcity with paper confidence. But behind every expansion, there's a deal with time. Debt pulls consumption from the future into the present, a temporal trade. In the 1950s, it looked like a miracle. Highways, factories, suburban homes, all financed by bonds. Yet by the 1960s, the math began to twist. The U.S. printed more dollars for Vietnam and welfare, while its gold reserves stayed fixed. By 1971, foreigners held more dollar claims than America had gold to redeem. President Richard Nixon didn't default openly. He suspended convertibility. It was the most elegant default in history, the moment the dollar became faith-based currency. And here's the hidden brilliance. Once money was no longer tied to gold, debt itself became money. Every new loan expanded the money supply, and every repayment destroyed it. Banks turned from intermediaries into creators. Governments discovered that deficits no longer required restraint, just central banks willing to buy their bonds. The Federal Reserve, once a lender of last resort, became a perpetual motion machine. Print, lend, repeat. The same pattern spread globally. Britain after 1949, Japan after 1970, Europe after the euro's birth in 1999. Every region built its own version of the credit engine. The rhythm was always the same. Promise future income, securitize it today, and let inflation wash away the difference. Yet, if you trace the chart from 1946 to now, you'll see the slope steepen. Debt to GDP ratios that once cycled between 30 and 80% now sit above 120% in the US, over 260% in China, and near 400% in Japan. The system can't slow down, because slowing means collapse. What the architects of Bretton Woods couldn't admit was that they hadn't built a stable order. They built a recursive loop. Each generation rolls the debt forward. Each crisis is solved by issuing more, and each expansion makes the next collapse larger. Keynes knew it. In 1940, he wrote, "The process of lending money we create is so simple that the mind is repelled." And yet we admired the simplicity. We called it modernization, globalization, growth. But beneath the jargon, it was always the same medieval alchemy, turning promises into wealth, then wondering why gold kept disappearing. If you see the world through that lens, 2026 stops being a mystery. It's just the arithmetic of the post-1944 machine reaching its natural limit. There was a time when the system seemed unstoppable. From the 1980s to the early 2000s, debt wasn't a burden, it was a miracle drug. Politicians promised prosperity, central banks promised stability, and the public believed that credit was progress. You could buy a house, a car, or even an empire on borrowed money, and everyone called it growth. Look back to the 1980s. After the inflation shocks of the 1970s, the U.S. Federal Reserve, under Paul Volcker, raised interest rates to crush prices. It worked, but at a cost. The economy slowed, unemployment rose, and politicians learned a crucial trick. If high rates create pain, then lowering them creates pleasure. And from that moment, the age of cheap money began. In the 1990s, the phrase financial innovation became sacred. Derivatives, mortgage securities, stock buybacks, all of them multiplied credit in new ways. Every innovation was really a new way to leverage time, to spend tomorrow's income today. Households took on mortgages, corporations issued bonds, governments ran deficits, and markets soared. The numbers looked infinite. Between 1980 and 2000, global debt grew by over 400%, while inflation stayed tame. Economists called it a great moderation. It was really a great sedation. The illusion was reinforced by technology. Computers made money move faster, globalization made labor cheaper, productivity seemed endless. In reality, cheap credit simply hid the exhaustion of real growth. When wages stagnate but debt expands, the illusion of prosperity survives, for a while. Consider Japan in the late 1980s, the world's future model. Land prices in Tokyo rose so high that the grounds of the Imperial Palace were said to be worth more than all of California. Banks lent freely because the assets they financed kept rising in price. It was circular magic. Until 1991, when it stopped. Then came the lost decades. The West learned nothing from it. Instead, it copied Japan's cure. Print more, lower rates, keep the bubble alive. By the 2000s, the system was global. China financed America's spending by buying U.S. debt, while American consumers bought Chinese goods with borrowed dollars. It was a perfect circuit, a planetary debt loop. Everyone owed everyone, and the interest fed the machine. The ordinary citizen didn't notice the trap. To them, debt was opportunity. Credit cards, student loans, 0% car financing, all signs that the system works. Politicians pointed to rising GDP and called it progress. But GDP doesn't measure sustainability. It measures motion. The faster the wheel spins, the better the statistics look, until friction appears. The illusion was emotional as much as financial. Debt democratized desire. For the first time in history, the working class could live like the elite, at least for a few decades. The gap between appearance and reality widened. Real wages flatlined after the 1970s, but consumption rose. How? Because credit filled the void. And who gained the most? The creditors, of course, the same banks, funds, and institutions that created the illusion. Every dollar of debt was an asset on someone else's balance sheet. Every borrower's dream was a lender's dividend. The system was never about fairness. It was about flow. As long as money circulated, nobody asked where it came from. But illusions have expiration dates. When debt grows faster than productivity, when returns depend on ever lower interest rates, and when confidence replaces collateral, the system is already past the point of stability. It just hasn't realized it yet. By 2007, it cracked. Subprime mortgages imploded, banks froze, and the myth of infinite leverage died for a moment. But instead of reforming, the world doubled down. Central banks cut rates to zero, printed trillions, and called it quantitative easing. Once again, crisis was solved with more debt, just as it had been in 1789, 1873, 1930, and 1971. The spiral resumed. The illusion didn't end, it evolved. It became digital, wrapped in algorithms and apps, made invisible through convenience. You don't touch cash anymore, you touch promises. The same pattern, just faster. And that's how every debt spiral feels before it snaps. Like progress, like innovation, like wealth. Until one day, the math outvotes the optimism. Every debt age ends the same way, not with ideology, but with arithmetic. The story is always told later as if a single event caused it, a housing bubble, a war, a crash. But those are symptoms. The real cause is simpler. Interest grows faster than income. And once that happens, no reform, no promise, no speech can reverse it. In 2008, the illusion snapped. It wasn't just mortgages collapsing, it was the credibility of the system itself. Banks that had looked immortal evaporated overnight. Lehman Brothers, founded in 1850, gone. AIG, Citigroup, Merrill Lynch, all insolvent without government lifelines. The very institutions that once financed empires had become dependent on the taxpayer. That was the quiet moment when private risk became public debt. Governments took the burden onto their books, and the cycle began anew, this time under the name stimulus. The numbers became surreal. The U.S. Federal Reserve's balance sheet jumped from $800 billion to over $2 trillion in a single year. Europe followed with its own quantitative easing. Japan printed endlessly. The goal was to restore liquidity, but what they restored was addiction. Every fix required a stronger dose. By 2020, after the pandemic, the dosage turned unprecedented. Lockdowns froze economies, tax revenues vanished, and the response was the largest money creation in human history. The U.S. alone issued over $5 trillion in new debt in 2 years. The same number that had taken 2 centuries to accumulate was added in 24 months. And once again, people called it salvation. But mathematics was already rewriting the script. As soon as inflation returned, the cost of debt servicing exploded. In 2021, U.S. interest payments were about $350 billion. By 2025, they approached $1 trillion per year. That's more than the entire U.S. defense budget, more than all social programs of the 1960s combined. Each percentage point increase in rates now adds another $100 billion in annual interest. You can't vote that away. You can't print it away without devaluing the currency. The empire faces a bill larger than its growth. History has seen this before. In 1788, France's interest payments consumed over half of state revenue, just before the Revolution. In 1931, Britain abandoned the gold standard when debt service crushed its exports. In 1949, it devalued the pound. Each time, the elites insisted it was temporary. Each time, the system reset under a new disguise. Politics bends under math. You can delay, restructure, or inflate, but you can't escape. That's when the mask falls off. The debates about ideology, left or right, become irrelevant. Governments stop governing and start managing decay. Public anger rises. And in every cycle, that anger finds a target. The rich, the bankers, the foreigners, the speculators. The names change, the pattern doesn't. In the U.S., that tension is already visible. The Treasury borrows trillions, the Federal Reserve buys the bonds, and taxpayers absorb the future losses through inflation. It's the same process as the assignats of revolutionary France, printed claims on non-existent wealth justified as public necessity. Back then, it ended with worthless paper and bread riots. Today, it hides behind screens and indices, but the mechanism is identical. Even the global balance resembles the late stages of empire. China, holding U.S. debt, begins to diversify into gold. Europe, fractured by energy crises, debates fiscal union. Emerging nations flirt with digital currencies to escape the dollar. Everyone senses the same thing. The center is over-leveraged. When mathematics breaks politics, governments turn to illusion again. They rename the crisis. Restructuring, soft default, monetary transition. But it's the same act, transferring losses from the powerful to the public through currency. Every era calls it differently. Every era means the same. And if the pattern holds, 80 years from 1946, then 2026 isn't just another election cycle. It's the rollover point. The interest due on the past century is coming home. The only question is whether it will be paid in dollars, in inflation, or in chaos. If this part reminded you that numbers, not speeches, rule history, leave a comment with one word: gravity. Look around you. Everything feels normal. Markets open, jobs exist, headlines move. But if you watch the numbers instead of the news, you can feel the tremor. The same forces that ended past empires are repeating, only this time digital and global. After 2020, the world entered what economists politely call a new monetary regime. In plain terms, that means the old debt system can't survive on its own anymore. Governments now roll over interest by issuing even more debt, and central banks quietly buy what no one else will. It's called balance sheet expansion, but it's really the state lending to itself. The United States, once the creditor of the world, has become its largest debtor, with obligations nearing $35 trillion. Europe floats on a sea of bonds propped up by the European Central Bank, and Japan has gone further, owning over half of its own government's debt. China mirrors the same pattern with its shadow banking system, where local governments owe money to their own state banks. Every corner of the planet is now locked in the same recursive loop: debt creating money, money creating debt. But here's the modern twist. We've digitized the illusion. The 21st century version of the assignat isn't paper, it's code. Central bank digital currencies, or CBDCs, promise efficiency, traceability, and financial inclusion. In reality, they're the perfect instruments for controlled inflation and silent default. When the next debt crisis hits, governments won't need to devalue openly. They can simply reprogram the currency, freeze balances, or adjust savings rates. It's the ultimate tool for managing collapse without admitting it. Meanwhile, inflation, the quiet tax of every debt cycle, has returned from the dead. Officially, it's under control. Unofficially, the cost of living in the developed world has risen 30 to 50% since 2020. Wages can't catch up, but debts remain fixed. That's how every system rebalances, not by paying the debt, but by eroding its value. When your salary buys less each year, you're paying for yesterday's deficits. And yet, optimism persists. Tech stocks rise, housing recovers, crypto booms. People believe the next innovation, AI, green energy, space, will outgrow the debt. It's the same story as the 1920s radio boom or the 1990s dot-com surge. Hope always spikes before mathematics calls the bill. History's rhythm is clear. Debt creates expansion, expansion breeds complacency, and complacency invites collapse. France's assignats bought bread until they bought nothing. Britain's war bonds financed empire until the pound was devalued. America's treasury bills financed dominance. Now they finance survival. The empire that once charged the world interest is now paying it. But the spiral doesn't end in despair. It ends in reset and in opportunity. Every 80-year debt crisis has birthed a new system. Gold after empire, paper after war, digital after inflation. The question isn't whether the reset will happen, but who will control the terms. Will it be the same creditors, wearing new names and running new institutions? Or will citizens finally see that the real revolution isn't political, it's mathematical? Watch the signals. Sovereign defaults disguised as restructuring, currencies tied to digital ledgers, asset bubbles justified as innovation. These are the tremors of the next monetary earthquake. And like all earthquakes, they don't destroy everything. They reveal what was already cracked. If you sense that we're living through the final turn of an old cycle, you're not imagining it. The numbers confirm it. The only unknown is how the reset will be narrated. Will they call it de-dollarization, digital transition, or the Great Stabilization? The names will change. The cause will not. Every empire leaves a monument. Rome left its roads. Britain left its language. Our age will leave its balance sheets, endless digits stretching into infinity. But behind those digits is something ancient and human, the belief that we can borrow from the future without consequence. History keeps correcting that belief. Arithmetic is the final empire, and it never negotiates. You can delay payment through politics, disguise it with inflation, or outsource it to another generation, but eventually, reality collects. The numbers that began as symbols of confidence become instruments of truth. When you step back, the 80-year rhythm isn't mystical at all. It's biological. One long human lifetime, the span it takes for those who built the last system to die and for their grandchildren to forget why the rules existed. Each cycle begins in faith, matures into leverage, and ends in revelation. Then, from the ruins, a new generation mistakes necessity for innovation and repeats the pattern. The warning isn't just about money, it's about trust. Credit, from the Latin credere, means to believe. Economies are built on belief, that paper is valuable, that governments will pay, that tomorrow will resemble today. When that belief cracks, systems fall faster than any army can conquer them. 2026 may not bring a single dramatic event. No fireworks, no headlines shouting collapse. It might simply mark the point where the illusion stops expanding. Debt will still exist, markets will still trade, but something deeper will shift. Confidence will fade. The math will have spoken, and the world will quietly begin rewriting its financial scripture. If there's a lesson in all this, it's not despair. Systems collapse not because humans are evil, but because arithmetic is honest. Numbers expose what rhetoric conceals. And every reset, as brutal as it feels, clears the ground for new beginnings. So if you're watching this before 2026, remember, wealth is not money and stability is not normal. Both are states of trust. Protect that trust in your own life through real assets, real skills, and real connections. Because institutions can lie, but reality can't. The historic debt spiral isn't just an economic story. It's a moral one. We've lived an age of borrowed time, and time, like credit, always comes due. Before you go, remember, this channel grows not by algorithms, but by awareness. If what you've just heard made you rethink how the world of money really works, don't let it vanish in the scroll. Hit subscribe, share it with someone who still trusts the headlines, and tell me in the comments, what part of this cycle do you think we're living through right now? Every voice matters here. Every comment, every repost is another signal that people are waking up to the pattern. So leave your trace below, not just a like, but a thought, because that's how truth survives the next debt cycle, when we talk about it together.